Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide. Here is Nathan Weaver.
Greetings and welcome to Kingdom's Wealth and Wisdom. I'm Nathan Weaver, founder and executive director of Petra Worldwide. For many property owners that face financial distress, walking away from the real estate feels like it's going to be a final relief for them. They think through a short sale or letting the property go into foreclosure that will end their financial nightmare. But for thousands of legacy builders, a secondary crisis silently brews in the background. Months, sometimes even years after the property is long gone, a piece of paper arrives in the mailbox that turns that real estate tragedy into a catastrophic tax bill. Because the IRS views the cancellation of debt as a financial gain. And without aggressively planning, you're forced to exit the property can trigger a tax bill that you did not expect. Today, I'm going to talk about the certainty and the mechanics of the distressed property transaction. What are the structural traps you need to watch out for in a short sale versus a foreclosure? And let's talk about the precise legal maneuvers that need to be done to protect your family's kingdom. To navigate the liquidation of real estate through distressed transaction, you must understand how the IRS classifies debt relief. The IRS operates under the fundamental rule: if a lender cancels, forgives, or otherwise discharges your debt, that forgiveness, that balance is legally treated as ordinary income. This single distinction catches distressed property owners completely off guard. So let's look at the two options that most distressed property owners face. The short sale being the most common, and this is when the buyer initiates a process of selling their home to a third party for less than the remaining balance on the mortgage. If the bank agrees and accepts the lower proceeds and writes off the remaining debt, that write off difference is legally captured as or categorized as cancellation of debt income. In a foreclosure, the lender initiates the process where the bank seizes the asset and sells it at auction. The tax consequence of that heavily depends on whether the bank has recourse or non-recourse loan. If it's a recourse loan, you remain personally liable for any deficiency. If the bank stops pursuing that deficiency and instantly converts it into ordinary income and a tax liability for you.
Pastors and financial leaders, do you need expert accounting or tax help? Do you have payroll or 1099 questions? Do you need a ministry expert to help you acquire real estate for your next project? If the answer is yes, yes, and yes, visit petraworldwide.org. Petra Worldwide has been strengthening ministries to transform humanity since 2007. Visit petraworldwide.org or call 855-481-9095.
So all is not lost because there are provisions in the tax code that will allow you some relief, but you have to know these provisions before you enter into the transaction. There is an insolvency exclusion that is allowed under the IRS Revenue Code Section 108. There's also a qualified principal resident indebtedness exclusion. Both of these exclusions are available to you, but understanding them up front is the key to execution. For the insolvency exclusion, for example, if your total liabilities exceeded the fair market value of all of your assets immediately before the debt was canceled, then you can legally exclude that income and you can get forgiveness, but you've got to fill out the right forms to do that. So all of these options are available. You just have to know your options. Navigating the tax liabilities of a distressed property sale is not easy. Visit our website and join the KingLife community. We're here to help you through these difficult times and navigate these waters side by side.
Listen every day at 4 p.m. for Kingdom's Wealth and Wisdom, brought to you by Petra Worldwide, strengthening ministries to transform humanity. On the web at petraworldwide.org.